This is the Build Wealth Canada podcast with Cornell Schreiber, session number 9.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell, and welcome to session 9 of the Build Wealth Canada podcast. Today, I'm excited to have Justin on the show, who actually managed to retire at the age of 33. This is a huge 2-part interview where we talk about everything from how he was able to retire at 33 to what he invests in. And we even cover some other subjects like how to save money on vacations and how he manages his money so that he never has to work again. Lastly, he gives us some great tips that you can start applying today to retire early. You can get all the links and information from this episode at buildwealthcanada.ca/9. And you can also go there to get part 2 of this interview. And while you're there, don't forget to sign up for a free newsletter so that you're the first to know when we have new expert interviews that come out. Also, I'll send you new tools and guides as they get released so that hopefully you can retire early just like Justin. And as a bonus welcome gift, just for signing up, you'll get instant access to my guide on the top 5 personal finance and productivity tools that you can start using today for free to save you time and money. All the tools in the guide are actually free, and I've been using them for quite a while, and they've really made a huge difference in terms of productivity and how easy it is to invest and save money. So I look forward to seeing you at buildwealthcanada.ca, and now let's get into the interview. All right, Justin, thanks for joining us.
Thanks, Cornell.
Just to start us off, can you tell us our story? You said you were able to retire at age 33, and that's what your blog is about. You're telling others how they can do the same. Maybe just tell us your story. How were you able to do this?
Sure, yeah. So pretty much started way back when I was in high school. I've always been very frugal, good with money in terms of not spending everything that I make. I've had a job pretty much the entire time since I was 16 or so. So I've saved. Back then, it was obviously not saving very much money, but I might save $1,000 out of making $2,000 during a summertime, working during high school, and just saved that money. And over time, it built up. I went to the university, got a degree in civil engineering. Then I went to law school, and then decided that I did not want to be a lawyer, so I practiced civil engineering. The salaries were a little bit lower in engineering, but I think the work-life balance was a lot better.
Right.
I managed to have a 40-hour work week most weeks, so didn't have to work real late or do a lot of business travel. So it was sort of a lifestyle choice to go into that career over law. Basically, we saved about half our income, our entire working careers. It added up, and we invested it in low-cost index funds. Over time, it just built up more and more and more, and eventually we had enough. Mm-hmm. So, that's in a nutshell. Have a decent income, save half of your income or more, and you can retire in your 30s.
That's great. Yeah, that's something similar to what we did as well. Is we pretty much put half of our income, except for us, what we did is we paid down the mortgage. And so we were 20, just before turning 29, we basically became mortgage free, because basically doing that same kind of strategy, just putting away half your income away. So yeah, it's definitely doable where we are as well. And it seems that's interesting that you had the same sort of 50% target that you were going for, and that's worked out really well for you.
Yeah, and it got up to probably 70 or 80% in the last year or two. As our incomes went up, we pretty much kept about the same. So starting out, it was more. And we also had kids in that 10-year period of working, so that our expenses did go up some, but not as much as you would think.
Mm-hmm, mm-hmm. Yeah. So how much do you need to generate per year to be able to basically live the lifestyle that you want?
Well, I have a budget for early retirement, and it's about $32,000 US per year. Mm-hmm. And then in 2015, I gave myself an inflation raise, which is only about $400. So 32,500, somewhere in that range. Mm-hmm. So it's not a whole lot of money, but that doesn't include a lot of things that regular wage earners have, like mortgage payment, taxes, paying taxes. We're going to manage to pay very, very little in taxes. I don't know how much $32,000 a year would incur tax liabilities in Canada, but down here with kids, it's zero.
Oh, okay.
So, but that's pretty much in a nutshell. And that 32,000 covers entertainment, travel, overseas travel, even use some travel hacking strategies, maintaining our house, heating, cooling. We have 2 cars, which we may go down to 1 car, but if we're not driving to work, we really only need 1 car. So we economize where we can, where it's not really a sacrifice, and then we spend plenty of money on groceries. We don't eat out a whole lot, but we make up for it in grocery spending, and we like to cook a lot. So we have pad thai and sushi, all kinds of Italian, Asian, Mexican food all the time. So we shop at ethnic stores, and we spend a lot of time cooking and enjoy that too. But the $32,000 a year figure, some people are like, yeah, I could do that easy, and some people are just, holy crap, we spend $100,000 a year. How can we can't ever live any kind of reasonable lifestyle?
Right.
Dollars, but a lot of it is keeping car expenses and housing expenses low, and then not paying very much in taxes at all. So.
Yeah, good luck living off that if you're living in Manhattan, for example, right?
Well, that's that's really the truth, is that we live in Raleigh, North Carolina, which is 400 or 500 miles south of New York City, and it's really New York is as different to Raleigh as Tokyo is to Raleigh. I mean, it's an entirely different world. Costs are different, especially with real estate. I mean, we have an 1,800 square foot house, and they sell for $150,000 roughly. And it's it's a regular house in a regular neighborhood, a few miles from downtown. It's not that sort of thing in Manhattan, though. Would be, I don't know, $2 million, $5 million. I don't know how much 1,800 square feet would be. But the point is that the cost of living varies so much between some areas like New York City, and then 90% of the rest of the country. Is the cost structure is much, much less.
For sure. Yeah, that seems to be a pattern that I'm seeing when I read others that have retired early, like Mr. Money Mustache, for example. I remember you've probably been on his blog. He talks about the importance of that as well. And yeah, for sure. I mean, if like in our case, it would be Toronto's kind of the common example where, well, if you're living in downtown Toronto, yeah, your cost of living is going to be huge, and it's really difficult. So it almost seems like if you do want to pull this off, you do have to strategically locate yourself in such an area where the house prices are lower, but you're still able to generate that sort of decent income. Like in our case, there's no way we could get the house we have now for 150. I'm actually a bit jealous of 150. That's amazing. So for you, you're like, oh well, you guys paid off your mortgage by 29. That's that's like 150,000. That's not bad at all. That's a joke.
Yeah.
But
I've heard about the real estate prices in Canada. And it's. I mean, there are places in the U.S. where it's the same way, where that are easily double here, and I see people talking about in the northeastern U.S. around Boston and New York and New Jersey, that area where $200,000 or $300,000 is sort of the bare minimum if you want to be near any of the cities and not way out in the country somewhere.
Exactly, yeah.
And there are areas of Raleigh that are just like that. We just happen to live in the part of town that isn't $300,000 and up for a house. So and part of that is just choosing where you want to live within an individual city and making the most of that. If we were going to live in a high cost city like New York City, we'd probably be scrimping on housing and in a 2-bedroom, 600 square foot apartment or something.
Exactly.
And the kids would have bunk beds. But I always say New York City is a great place to visit, but not as much to live. And I think most people with families would agree, at least as to Manhattan. Outside of it, there are pros and cons to living outside of New York City. But
for sure,
it comes down to what do you want to get out of life and where do you want to live, and do you appreciate? Do you get a huge benefit out of being in a big city where they have 10 times as many museums as you can visit in a month? Do you appreciate? Do you get a huge benefit out of being in a big city where they have 10 times as many museums as you can visit in a month? Do you appreciate? Do you get a huge benefit out of being in a big city where they have 10 times as many museums as you can visit in a month? you can always fly there. It's 400 or 500 miles away. It's not that far to fly or drive or take the train.
Exactly. And I imagine those museums might get boring after you've been living there for a few years. So in our case, what my wife and I would do is we would just go to a different country or different city, and you see the museums there and you see the attractions there. So every time you go on a vacation, you see something new, right? And that's a lot cheaper than paying Manhattan real estate prices, for example, or Toronto real estate prices. Mm-hmm.
Yeah, exactly. And we went to New York this summer. We actually drove to Canada and stopped along the way in Philadelphia and New York, and on our way up, and spent a couple of days in New York City. So we got to experience the subway and ride around
Mm-hmm.
and check out museums, and we sort of saw the fireworks on the 4th of July, our Independence Day down here.
Right.
But I gotta say, Montreal's fireworks festival is much better than New York City's 4th of July fireworks.
Oh yeah.
Yeah, it was pretty amazing.
Mm-hmm.
So we ended up in Montreal, and they happened to have the fireworks festival, and we were staying close to the river, so we got to see that, and that was pretty awesome.
That's amazing. Yeah. That seems to be a good strategy. Yeah, just to enjoy, just travel and then see things, and then go back to your home where it's not so expensive to live on a day-to-day basis, essentially.
Yeah, and if you analyze what you do on a day-to-day basis, if you can read a book sitting in on your sofa,
Exactly.
Living, you can go out walking on greenway trails or hiking, where it's low cost of living, and I don't personally spend a ton of time in museums,
Mm-hmm.
and playgrounds or activities for kids are pretty much the same wherever you are. I mean, you can only get so much value out of those different things.
Mm-hmm.
So yeah, if you pick a lower cost of living area that still offers a reasonable quality of life,
Mm-hmm.
it's to me, it's not really a sacrifice at all. And in fact, there are a lot of positives to it. And the fact that we're only 4 to 8 hours drive to New York, Washington, D.C., maybe a little bit further to Boston,
Mm-hmm.
and flights are an hour or so. So it's not that far away, really.
Exactly. Yeah, I always thought that if you're going to be living in a big city center like Manhattan or Toronto or any place like that where the real estate is so expensive, you better be pulling in that really, really high salary to be able to offset that increased cost of living. And if you're not pulling in that kind of salary, then hopefully you have some amazing job where it's building your portfolio. It's so that so it's like an investment, and that in the future you're going to be able to get that really high paying job, that kind of thing. But if you're not, if you're just kind of living there and you're living just have a kind of a normal job, then it's it must be really tough to save and then to pay off your house. So it's better just to look to a lot less expensive areas, because I hear that a lot here in Canada, right? People say, well, I live in Toronto, there's no way I can pull it off. Well, I'll say, well, if you're living in Toronto, you should be earning a pretty big salary to help offset that. And if you're not, well, then are you sure you should be living in Toronto? Maybe here there are plenty of other cities with really high-paying jobs. It's not like there's only high-paying jobs in Toronto. So, so I see a lot of people kind of get the shaft that way, where they think, oh, we have to live in this expensive city just to get a job. But often that's not the case, I find.
Yeah, that's absolutely true. And I think that in the United States, the regional differences in pay, I don't think it compensates you for the huge spikes in cost of living in some of the big major metro areas. The exception to that would be if you're in finance.
Right.
New York City is probably one of the best places to be, and you can make $300,000 or $400,000 or $500,000
right.
if you're working with a big bank. You'd probably make half of that or less in virtually every other big city. Maybe some of the ones in California. Maybe you might find a job somewhere else. But in general, in middle America, you'd be making half of that. So, if you can economize in a high cost of living area, you can certainly have a shot at making a lot more money. Same Silicon Valley for tech workers, San Jose, San Francisco, that area. There's just so many more opportunities to move around to different companies or to work for a startup that can get big and make you tons of money. Those sort of opportunities, it's harder to find those type of tech jobs. There's just a different culture environment elsewhere. But even places like Raleigh or Austin or Atlanta or Nashville, I mean, lower cost of living areas that aren't where it's not $1 million to buy a tiny little 3-bedroom house.
Exactly.
There are areas like that in the U.S. So I think it pays to be mobile and pay attention to your cost structure wherever you're living, and does it really pay off if your goal is to maximize your earnings and minimize costs? It may pay off to locate somewhere that's low cost of living but still offers great job prospects. And then there's always the environmental aspect. Do you like where you live? Maybe you love the weather on the West Coast. Maybe you love the weather. Maybe you love the winter time, so you want to move north. There's a lot of factors in it, but I think that it's hard to ignore the costs of where you live compared to what you make.
For sure, for sure. Yeah, I find Canada's pretty similar in that regard as well. You'd make more in Toronto, for example, but I find it's not that much higher, at least from what I've seen, to completely offset the increase in cost of living. Unless, like you said, we have Bay Street, right? And it's same kind of thing. If you're an investment banker, then sure, that would be the exception to that. And for sure, there's outliers and exceptions, but I find generally that's kind of the case. At least from what I've seen, it's not worth it unless you want to live there for the lifestyle piece, right? And that's kind of a whole nother discussion altogether. Now we're talking more lifestyle as opposed to just money. Yeah. So you mentioned investing in index funds, and that was your key. So when 2008 happened, you must have taken a pretty big hit. So can you talk a little bit about that? How did that affect you? I imagine that, emotionally that must have been a rough time. So yeah, maybe speak to that a little bit more for all of us that fear the next crash.
Yeah, I mean, it was a scary time, but I think half the fear among everybody was just fear mongering. I mean, we're afraid of fear itself. Where, if you think about your finances day to day, I had a paycheck, my wife had a paycheck. We only spent half of those paychecks. We had money in the bank. We had hundreds of thousands of dollars in the bank, even at the very lowest point. Mm-hmm. So in terms of, were we going to lose our house, or were we going to be on the street, or destitute, or starving, or none of that was ever a reality for us. It was scary losing probably close to half of what we had in investments, and watching day after day of large 1% or more losses on the way down. But if you step back and think about it, well, you have a job. Now, some people lost their jobs. I mean, my company laid off a quarter of the workforce, and then froze wages and actually cut the wages temporarily across the board. So it was scary from that perspective, in that my company was hit so hard. And so I was sort of thinking, well, I may lose my job. But then we knew, well, we spend so little that we can make it on one income just fine, and we have our investments to provide an income, a small income at the time. But we could live off of the investments too, and sell those if we need to, because that's sort of our $250,000 emergency fund back then, was our investments. So I just kept investing, though. I just kept automatically piling the money in every month through our 401ks down here, 401k and IRA investments. So most of my investments were all automated in terms of where the money's going, and it takes the emotions and the psychology out of it when it's just coming out of a paycheck. I'm used to seeing a certain level in the paycheck, and all the investments just happen in the background. Mm-hmm. So I didn't have to think about, oh, well, should I wait until next week or next month to invest this $1,000 or this $2,000? Because what if it keeps going down? I don't want to buy it too early. Well, I didn't have to even face that obstacle, because it was on autopilot through employer deductions, and I'd set up an automatic recurring monthly investment to my Vanguard account, just to take that psychological, emotional side out of the investing. So mm-hmm. pretty much just kept investing all the way down to the bottom in March of 2009, and then I was shocked that it went up so quickly after. Yeah. But I was fully invested, so it wasn't, mm-hmm. I wasn't regretting it. I was happy at that point.
Sure.
That things were doing so well.
So when you saw those big drops occur, I mean, one of the things I remember you mentioning on your blog is that basically, the stocks became on sale essentially, and so you started buying them up, which makes complete sense. Now, did you have some way of determining of, okay, this is a significant of a drop that I should start buying them up, or not? Did you not even really go into that kind of thinking or analysis, because like you said, it was all automate. You've set everything up so it's automated, so you're automatically investing that money every month, so you're just consistently investing the same amount and basically not worrying about the timing?
Mostly the latter. I never set aside any money to wait for stuff to go down. I think I convinced myself probably 3 or 4 different times that this was the absolute bottom, and there's no way it can go any lower. But that didn't really impact the decisions I was making, just because I didn't know when the bottom was going to hit. I think when it first started going down a lot, I was actually on vacation at the beach here in North Carolina.
I hope I didn't ruin it too much.
No, not at all. I mean, I was to the point where I think it went down 7% in one day.
Right.
But it's just a number, it's just a big red number on the
browser.
Yeah, look at this number, and I'm just like $7,000 times, I don't know, we had maybe $300,000 then, so I was like, okay, well, we just lost $21,000. Turn the computer off, go out to the beach, hang out, and have fun.
That's right.
What's the point of wasting your vacation when you can't do anything about it? And this was all. It wasn't like this was money that we had to live on immediately. This was long-term money that we were going to be spending. This was 2008, I believe. So this was money that I knew we would be spending sometime 5 to 10 to 15 years out at the earliest for early retirement. And a lot of it we wouldn't spend until we're in our 50s or 60s. So it's just tons of money that you lose and you make, but it goes up and down and it fluctuates. And
exactly.
I think that the sooner you can get comfortable watching yourself lose $10,000 or $20,000 in a day, and just sort of say, okay, well, I'm just going to turn the computer off and go outside and play and do something fun, because it's a long-term, it's a long-term game of years and decades, and not of day to day. At least, how I manage it. I've looked at it as long-term buy and hold. A lot of the stuff that I've bought, on day one or the first year of investing, I still hold the same funds, same investments. Haven't sold, other than rebalancing a little bit here and there. Haven't sold hardly anything.
Right.
So,
yeah. I find that that mindset helps a lot. What I tell myself whenever there's some sort of drop or fluctuation in a negative sense, just say, it doesn't matter really, because I'm in this for the long term, and so it's useless to actually worry about it, and just reminding yourself that this is long term. This doesn't really matter right now in the present time. I personally, that's what helps me kind of get through it. Mind you, I didn't experience the 2008 in the way you did, but I find that's a good thing to tell yourself when everyone's saying the sky's falling and sell everything, right?
It was. I think the most challenging part was going to work every day and listening to people around me and the company management.
Oh yeah.
Just freaking out, and because they're all listening to the news, and they're listening to Jim Cramer on Mad Money down here, and the CNBC, all the business channels. They're watching all this stuff, and they're just freaking out.
Right.
And I'm assuming they were as financially solvent as I was, if not more, because they own the company as a small engineering company.
Right.
But they're worried about the dollar disappearing and money market accounts losing half their value overnight, and a conspiracy theory level of worrying about stuff. And I'm just kind of like, it's not that bad. It's really, this is a great buying opportunity for everyone. But just listening to that negativity and worrying and fretting over everything. I could tell at that time that it wasn't really as bad as they were all thinking it was, but that is a challenge to kind of close your ears and just keep on doing what you're doing, that long term will be the right thing.
Exactly. Yeah, I remember that had a pretty big impact on me. I remember I was pretty much fresh out of school, university, when it happened, And I remember, I'll never forget it kind of scared me from investing for a while. And it's what contributed me to just going, let's pay the mortgage down quicker. Because I remember on the one day, I remember my director just kind of not freaking out, but he was obviously, not in the happiest mood, because he said he just lost 30 grand in a single day. And so obviously, when you hear things like that, and you're just fresh out of school, and you're not as educated about how the markets work, and long-term investing and all that, that sounds really, really scary. And I remember that kind of got me scared of the markets for a bit. Now it's a completely different story, now that I've actually spent a lot of time educating myself over the years. But I remember, yeah, those can be discouraging times for the new investor, for sure.
Yeah, and it's, I mean, you just gotta get used to making and losing money day to day. And the way I look at it is not necessarily, did I lose $30,000 yesterday, because that actually happened, I think, last week or 2 weeks ago. But the bigger thing is, hey, if I lost $30,000, I still have 1.3 million, and take some zeros off for people that are just starting out. I lost $3,000, but I still have $130,000. If you focus on what you have left, it's huge compared to what you just lost. Even if there's a massive one-day loss, you still have most of what you started with.
Right.
And I haven't ever experienced like the October 1987 crash. Here it was, I think, 23%, 24% in one day. That would be pretty scary. But in terms of, what am I doing tomorrow? Well, I mean, if I have any cash laying around, I'm probably going to throw it in the market and try to invest it.
Mm-hmm.
But it's paper losses until you have to sell your investments. And if you're trying to build up an investment portfolio to live off of in early retirement, you're talking about 30 or 40 or 50 years worth of savings, or to live off of for 50 years. And so you only need 3 to 4% of that per year. So you got to get comfortable with losing within a day or a few days or a week. You're going to be losing a year's worth of expenses within a week, probably once a year. It's just going to happen.
Right.
You're going to get back over the long term. But that sort of volatility, if you can't handle that, then stocks are probably not the best place to put your money. You got to get the right kind of investments in there. Otherwise, you're going to end up panicking and selling after it goes down, which is the exact opposite of when you should sell.
Exactly. Now, yeah, you mentioned actually, before we go on, I remembered you mentioned putting money in your RRA and your 401k. So just for our Canadian viewers, that's basically like our RRSP and our TFSA. So the Roth is the Roth versions are basically like the TFSA, and the more traditional IRA or the traditional 401k, that's basically like our RRSP. So
okay,
yeah.
RSP is you get a tax deduction, and TFSA is you pay tax on the money, but then you put it in and it grows tax free.
Exactly, and when you withdraw it afterwards, it's tax free essentially, because you've already paid tax on it initially. Whereas RSP is more, it's more like your traditional IRA or your traditional 401k, where you're not taxed. You get to invest it right away, and it can grow. It can start compounding pre-tax. But then when you take it out, then you get taxed.
Right.
Yeah. So basically, just what you were saying before, essentially, you were trying to max out your 401k, your IRAs. You're trying to basically pull that to the max, just to shelter them from tax, let them grow as much as they can, basically.
Yeah, and I don't know. I know the tax brackets and the tax structure is somewhat different in Canada, but just to give a kind of a quick overview of how it worked here in the U.S., this may carry over some to Canada. We always knew our incomes were a lot higher while we're working, because we're working and earning enough money to save half of it and spend half of it. So we knew our expenses in retirement would be half or maybe a third of what we're spending while working. So we always said, well, okay, we can basically pay close to no tax in retirement, and we can wait 20 or 30 years to pay that tax.
Right.
And in the meantime, save that money on taxes and invest it and use that to grow and pay that future tax as we need to.
Mm-hmm.
So yeah, we just saved everything we could in these tax deferred accounts to take a tax write off, and paid very little tax while we were working. Even when we had $100,000, $150,000 combined incomes, we paid almost no federal income tax. So it got us out of taxation while we were working. And there's other taxes here, like our Social Security, payroll taxes, and state income tax, that it's hard to avoid those. So we did still pay probably $10,000 or more while in our highest earning years for all those other various taxes,
Right.
that are almost impossible to avoid if you're working, if you haven't earned income. But yeah, the whole idea was we're going to be making a lot less money in retirement, so let's take the money from our 401ks and IRAs in retirement, our RRSP equivalent, in retirement, because then our taxation will be 0% or close to 0%. We have a 10% bracket for that. That's the first income tax bracket here. So I'm just like, hey, I can fill up that 10% bracket and still do way better than if I was paying 25% while I was working.
Yeah. Yeah, well, I'll have to get some Canadian tax expert accountants on the show and see. I'll tell them that you intrigued me with these strategies, and is there some sort of Canadian equivalent? Because I know for sure there are differences between the 401k, like basically with the tools you guys have in the States and in Canada. So even though we kind of have our RSP and our TFSA, which is kind of the most comparable thing that we have, there are some differences between them as well, I believe. So yeah, I'll have to save that for our accountant interview, and we'll see if if we can employ some of what you employed in the US here in Canada. Yeah,
That sounds good.
What's that?
I'm not an expert. I'm not a Canadian tax expert.
I definitely don't expect you to be. Yeah, you'd be a very interesting person if on your spare time you are researching Canadian tax laws while living in the States. I definitely wasn't expecting you to know that. But no, that's something for sure. I'll have to get some pros on the show here in Canada who specialize in that kind of thing. Because that for sure, taxation is such a huge component of your expenses, right? And if there's a way to legally minimize that, for sure, it's definitely worth looking into. It's one of those kind of 80-20 principal rules, right, where it can really make a huge difference.
It saved us around $20,000 a year by taking advantage of all these tax deductions and tax breaks.
Yeah. And
totally legally. I mean, it's
right.
Not anything out of the ordinary. I mean, it's out of the ordinary in the sense that a lot of people do not take advantage of it or cannot take advantage of it. But so that's real money if you compound that over 10 years and save all the difference and then invest that, then you can end up with hundreds of thousands of dollars just from paying attention to taxes.
For sure. Yeah, it's not the most exciting subject, but it gets exciting when you get to keep your money. For sure. Yeah, that's great. Going back to the when you're talking about 2008 and the market drop and basically the stocks were on sale. It was a good time to buy. Did you basically use any sort of leverage? Did you borrow any money to invest more during that time, just because you knew that you would be getting a really good deal since you're investing long term?
I did not. All I had was just our earned incomes, and I mean we put pretty much every penny we weren't planning on spending that month into markets, and we were investing as much as we possibly could.
Gotcha.
And we didn't really have any cash emergency fund on hand at all. So in that regard, we were putting everything we could in. The only I very briefly thought about getting very highly leveraged by applying for a lot of credit cards and taking cash advances, like maybe $1 million worth, and putting it all in the stock market on with options or some other just crazy, ridiculously leveraged investments.
Right.
With the idea being I either go bankrupt or I make millions of dollars.
Right.
And in hindsight, I probably would have made. I think the timing would have worked out where I probably would have made $1 million or $2 million extra.
Wow.
If I can get the $1 million to start with, which credit was pretty easy leading up to this. So I mean, it may have worked out, but I don't know the timing of it exactly when I had this crazy idea. So I mean, if I bought too early, it could have easily gone to zero, and then we would have to file bankruptcy.
Right.
So anyway, that was the idea I had at one point, was to just borrow as much money as I possibly could, and if I can't pay it back, well, file bankruptcy. I decided not to do that. So
Right. Yeah, and for all the listeners to the show, we are definitely not recommending that you take on massive credit card debt to buy as many equities as humanly possible in anticipation of the market going up.
What really made me think about it was the way that debt, the attitude towards debt, got really funny back in '08 or '09. The real estate bubble bust back in, I guess, 2007 or so. And so people in California and Las Vegas were buying up just any house they could find. And they were getting free money from the bank, borrowing at excellent terms. And they had liar loans where you basically could just get this money with no money down. And so people were borrowing millions and millions of dollars, and their underlying real estate would go up. Even if it only goes up 10 or 20%, if you have zero down, you're 100% leveraged. You have no money in the game, so your return on investment is infinity.
Exactly.
And then when the market crashed and the real estate values dropped, these people that had these loans sort of just walked away from them. And there was, in California, there's actually no recourse against some borrowers don't have, the lenders do not have recourse against the borrowers, so they could literally just walk away from those loans. I think that's limited to the primary residence, but basically there was an incentive there to borrow all the money you could, and then, hey, if you couldn't pay it, walk away, file bankruptcy, whatever. But maybe you can make $1 million or $2 million first.
Right.
So that was sort of what generated that idea in my head of this is just from a purely financial instrument standpoint. I'm not saying that ethics are right or wrong. I was just observing what people are doing in the market to potentially make a ton of money with tons of risk, and with the downside risk being that you just go bankrupt.
Right.
So yeah, I mean, it would have been, the outcome would have been I would be bankrupt if I would have done that potentially. So that, just to give some background on where I came up with that idea. But it's in general, it's a very bad idea unless you have no assets and you really don't mind cheating banks out of $1 million or whatever.
Yeah. So now let's talk about asset allocation a little bit, because basically, what was it before you retired, and what is it now? I assume you've modified it a bit just to give it a bit more lasting power and to kind of shield yourself from volatility, since you're actually using that money to live off now. Can you talk a little bit about your asset allocation before and after, and then what changes you made to it?
Sure. Yeah. So I kind of went against the general advice of getting more conservative in retirement. During my working years, I was 100% equities. And like I said, we had around $3,000 in our checking account on average at any given time. And that was just to pay the bills for that month, because our paychecks were coming in and we always had a surplus every month. So I was 100% equities and very, very little cash while working. In retirement, I stuck with pretty much the exact same asset allocation, 100% equities. So I still have virtually everything invested in equities.
Okay.
There's probably a few percent of, I think I have one bond that will be my 2017 living expenses. Other than that, I have roughly a 1 to 2 year cash buffer that I use. And so, is that part of my asset allocation? Well, I don't really consider it to be part of my asset allocation, but the reality is I can go a year or two without having to sell anything from my investment portfolio. So yeah, it functions as a buffer to volatility, in the sense that if values drop tomorrow by 30%, I would just live off of the cash and I wouldn't sell any investments.
Right.
If the values went up 30%, I'm going to be selling some more investments to raise some more cash, just so that I can stretch that cash buffer out even more. In fact, right now I have some limit orders in just to raise another 6 months to 1 year of living expenses, just because I don't know if we're at a top or not, but I figure why not go ahead and get the cash locked up so that I can have my 2016 living expenses sitting there in cash.
Right. Okay.
So it's sort of, I'm just taking it a year or two at a time, and getting myself through the next few years. Now, if we have another prolonged downturn, I'm going to end up selling equities at a loss. there are ways to get around that by spending less money, getting part-time work, ramping my blog work up more, spending more time on it, doing freelance writing, going back to work full-time. I mean, those are all potential outcomes that could help me avoid spending from my portfolio in a down market. And, I'm 34 now, so it's not like I'm never saying I'm never going to work again. I don't know. I may get bored.
Right.
But I think it would have to get pretty ugly before I would go back to work full time. So,
especially when you're used to not going to work.
Yeah, it would be a big crimp on the lifestyle.
Yeah. You'd be like, what is this commuting thing you're referring to? This doesn't... You do what every day? You drive to work?
It's only the commute here is about 10 minutes, so it's not...
Oh, okay, it's not bad then. But you talk to some people that, commute for 45 minutes, an hour or more every day. Yeah, that's interesting. So basically, it sounds like what you do is So you've got the money, or the equities, they're growing right now, and then when you see that the prices are kind of where you'd like them to be, where you can sell them at a pretty nice gain, then every once in a while when that happens, you sell some of them off to basically secure a certain number of years of retirement, essentially.
Yeah, in a nutshell, I mean, I'm not trying to time the market as much as I like to keep about a year or two worth of cash,
right,
just sitting there to fund the next year or two of living. And I think it's probably more psychological than hard numbers based or analytically based. It just helps me sleep at night if I know that we're going to have enough money to live for the next year or two,
right,
without in cash, without worrying about selling things after they've gone down, or timing when I'm going to sell that, or if a large expense comes up, a big lumpy expense comes up, like if we have to replace a car or something.
Right.
I have the money sitting there in the account, and I don't have to worry about, what am I going to sell to fund this, or what am I going to sell to get us through this big expense period, even though it's a one-time thing. So for me it works, and if I had a larger bond allocation, or any bond allocation really, I wouldn't feel like I needed as much cash laying around, but just because of the way it's mostly equities, that dividends. So between the cash on hand and the dividends that we get, that is basically our living expenses for the next few years, and then that cash bucket will be topped off from selling equities, hopefully when they've appreciated.
Right. Okay. So do you find yourself, now that you're in retirement, do you draw on the balance? Basically, do you take money out of your principal now as well, or do you try to make it so that you're not drawing on principal, you're just living off the dividends or the interest, etc.?
So far, I haven't sold anything out of the account, but like I said, I have a limit order in right now. I'm trying to sell some stuff. So if the market goes up a few percent, that will represent my first sale from my investment portfolio.
Oh, okay,
yes.
Gotcha. Yeah, so the goal is to just live off the to not draw basically down on the principal at all. But then in your case now, you're going to do that a little bit. But yeah. Now that you're okay, gotcha.
Yeah, I'll have to sell some of the principal over time, but part of that is the tax strategy, because I have about a quarter of our net worth is in brokerage accounts, taxable accounts that we can access at any point without any kind of penalty.
Okay.
And so I'm going to be living on that for the next 10 to 12 years probably, and then doing some other fancy tax work that I won't get into for Canadian viewers on the tax deferred side, our RRSP equivalent, to funnel that into the TFSA type of stuff. That's what I'm doing behind the scenes, but in terms of our living expenses, it's all sitting in a taxable brokerage account, what we're going to be spending the next 10 or 15 years. So.
Okay. So how did you decide that, okay, this number that we have now in our accounts, this is enough now for me to retire on? Can you take us through the thought process that you went through to basically say, hey, I have enough to retire, let's do this?
Yeah, it's a process that took me a long time to get to, and basically I worked in it from what are we spending now, when working, what are we spending now, and then taking out work-related expenses, commuting costs, nicer clothes, keeping up a nicer car that's reliable so we can get to work, any lunches out, professional dues, anything like that, expenses that are related to work that would go away when we retire. So I took what we were spending minus those work expenses, and then added in the extras, the fun stuff, like a bigger travel budget. Once we have time to travel more, we want to spend more money on travel. So we added in a travel budget, a bigger travel budget beyond what we were spending before. We added in some for healthcare, just because the employer provided health insurance here goes away when you retire, so you have to fund your own, which is pretty moderately priced now with our Affordable Care Act at the income levels that we're at. So anyway, I took what we were spending, took out work expenses, and then added in the extras that are related to retirement expenses. Added all that up and tracked expenses for the last 4 or 5 years, and figured out that we're spending the core expenses were around $24,000 a year after taking out work expenses, and then we added in about $8,000 more to cover health care, dental care, travel expenses. So we sort of, it was a very analytical method of determining what we're spending. So then we get $32,000 a year. Then you figure, okay, you can spend, there's that 4% rule I'm sure you've heard of. You can spend 4% a year. Well, that's more if you're spending for about 30 or 40 years. So if you look at it, probably 3.5% to 3% is closer to what you can spend if you're in your 30s and planning on hopefully making it 50 something more years. So if you're looking at a 50 to 60 year retirement period for planning purposes, we use a 3% withdrawal rule. So yeah, you take 3% of $1 million and you have about what we're spending each year.
Okay.
And then we added some extras in there to cover college expenses, some other one-time expenses that we expect in the future. A lot of that's kid related. That we're not going to have kid expenses forever to infinity. So a lot of those we treat as lump sum expenses that we're going to have to pay eventually. So we needed more than $1 million to fund $32,000 a year living expenses, just because there's some big lumpy expenses in the future related to college and other child costs.
Right. Yeah. Okay. Gotcha. So you just said, okay, 3%. That's what we're that's the safe withdrawal rate from our portfolio, so that we're not drawing down the principal or barely drawing it down, to make it the most sustainable for the long term. That's what you're saying.
Yeah, and okay. If you look at the dividend yield on the portfolio is probably 2.5%, roughly 2.25%. So if we're spending 3%, we're spending slightly more than what the dividend yield is, but just because of the tax structure of where we hold it, we can't just live off the dividends.
Right.
So we're selling some stuff, but yet we're also reinvesting dividends elsewhere.
Oh, okay.
But like our dividend yield, our dividends last year added up to about $30,000, but only $10,000 of that were dividends that I could touch. The other $20,000 were in retirement accounts that it didn't make sense to touch them at the time because of the tax consequences. So we're down to that point now where we're basically living off of the dividend yield from our portfolio. There's a pretty good chance that $30,000 per year will grow over time to the point where it'll fully cover what we're spending and maybe even more. It just depends on the sequence of returns and how the market does and how earnings grow, that sort of thing. So the goal never was really to cover all of our living expenses with dividend income, but it's just because of the way the math works out, we're spending so little as a percentage of what we have that the dividend yield does just about cover our living expenses.
Okay. So you're saying that covers almost all of it, and then sort of the difference you get just through your sort of tax efficient planning, essentially? Is that kind of the gist of it?
Well, it's I guess it's really, we can't access all that $30,000 per year of income right now. So we can get about $10,000 of it in our taxable. The other $20,000 of dividend income, it gets reinvested. So we're basically, to use an illegal phrase, laundering money from our, I mean, it's not illegal or anything, but we're making $20,000 in our retirement accounts, and then we're investing that in $20,000 of new stock we're buying. then we're selling $20,000 of stock in our taxable account. So we are selling principal in our taxable account, but we're also buying new principal in our retirement accounts.
Okay.
So the net is that if we can spend $30,000 a year and make $30,000 in dividends, the net impact will be we have the same amount of principal that we're not selling any of the principal. But I mean, we are to fund just because of the tax structure. We are in the taxable account, but not in the tax deferred accounts. It's sort of complicated to explain it.
Right. Yeah. And then and then it might not apply to Canada either as well, because I don't know how we'd have to get, like I said, a tax pro to do it. But
it's very specific to where our money ended up and how much is in tax deferred and taxable accounts. And so it's I think it really, it's just very unique to our situation and it's pure coincidence that we happen to spend about what our dividend yield is right now. That was never really an explicit goal, but it's certainly, I think there's some peace of mind that we get from knowing we could just try to live off the dividends and move money around here and there to access those dividends.
Sure.
But if we can do that, then we can live off the portfolio essentially indefinitely. Okay. Because dividend fluctuations are much less than the portfolio value fluctuations are.
Okay, gotcha. And when you said when you're collecting the dividends, are those from dividends from your index funds, or did you start buying individual companies now and collecting dividends from those?
It's all index funds.
Okay.
Yeah, we never had an explicit dividend focus in our investments. It's just between the U.S. based index funds that tend to pay a little bit lower dividends, and then we have a lot of international investments that tend to pay significantly more dividends.
Okay,
it just averages out to I don't know what 30,000 on 1.3 million, whatever that is. It's less than 3%, but between around 2.5% to 2. I think it was 2.25 in 2013 and maybe 2.5%, 2.75% in 2014.
Okay.
The yield. Yeah.
Okay. All right. Well, I hope you enjoyed part 1 of the interview with Justin. You can get part 2 of the interview and the show notes at buildwealthcanada.ca/9. So just the number 9. And while you're there, sign up for our free newsletter so that you're the first to know when new expert interviews like the one with Justin get released. And of course, as a bonus, you'll still get the top 5 personal finance and productivity tools that you can start using today to save you more time and money. Lastly, if you are an iTunes user, I'd definitely appreciate if you gave this podcast a rating. It helps a lot in getting great guests on the show like Justin. The more listeners there are, the more guests want to come and join and be part of the show. And so I definitely appreciate you leaving a review to help make the show more popular and help attract better and better guests. Also, if there is a particular guest that you would like to see on the show, or if you have any sort of personal finance or investment related questions, feel free to let me know as well at buildwealthcanada.ca. And I will do my best to get your question answered and bring in anybody else that you'd like to see on the show as well. All right, well, so thank you in advance and talk to you soon.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.